Alright guys, welcome to another video. So in this video I'm going to talk about private banking. In particular, we're going to look at Goldman Sachs private wealth management. If you're someone who is thinking about putting your money into a private bank to get access to family office services, investment advice and asset protection, this video is for you. Because what we're going to do in this video is we're really going to pierce the veil of the wealth management industry, because it's worth over $100 trillion industry. And in this video you're going to see exactly why and what the solution is to the problems that we're facing right now. So let's get into it. So I'm on the Goldman Sachs website and we're going to go through it and have a look at some of the services that they offer. Yeah, family office services. Yeah, and look what we have, right? We've got professional advisors here who are going to help you accomplish your goals. So what I want to say about private banking is a business. It is a business, and the clients are the ones bringing in the money. Normally what happens is any investment advice, we can already predict what investment advice they're going to give you. It's probably going to be a 60-40 portfolio, typical S&P 500 ETF with some bonds or some treasury bills. Because let's be honest, these people here, they're salespeople. They are using you as a sales funnel, as a wealth extraction, and they're using your balance sheet to do it. That might sound a bit aggressive, but it's the facts. When you see the spreadsheet, you're going to understand. What people do not know about Goldman Sachs, I'm going to tell you a secret about Goldman Sachs. There's two types of clients they have. Let's assume the civilian client who has maybe just sold a business and they have $10 million or whatever. They're the ones who go into the box of wealth planning, relationship manager, and they're getting charged an asset under management fee, and they're getting the sort of hand-holding experience. Then there's a full section of Goldman Sachs which is just purely for using them as a prime broker. So the people that really know what they're doing say open an account with Goldman Sachs and it's just purely for execution. It's purely just to execute the trades and just to use them as a broker. They don't care about the investment advice. They don't care about wealth planning, because they already know how to do all these things. And they already know the investment advice is massively conflicted. Do you think any of these people are even allowed to say, invest in Microsoft, invest in Nvidia, invest in Google? They can't physically, legally cannot tell you to do that, right? So they have to give everyone the same portfolio, pretty much. And even then, it's just going to be limited. And these people they're not. I just don't view them as active professional investors. They're not. That's just not their job. Their incentive is to collect asset under management fees, to sell Lombard loans, and to sell policies and asset protection. It's the biggest misconception is you need a private bank to set up irrevocable trusts and to get asset protection. It's a complete myth. You do not even need a bank at all, actually, a private bank at all. So we're going to break this down. In this video, I just want to talk about the actual asset under management fees. So let's look at the spreadsheet. Let's imagine a client with $10 million, like they just sold their business, $10 million, they go to the private bank and they get given a portfolio and they get charged 1.25%. That's quite conservative. Net return is 5.75%. So what does that look like? Because the 1.25% AUM fee, it just sounds like a tip. Because in year one, that's $125,000. Okay, they give, when you walk in and you see the nice fancy building, they give you a free lunch, they give you some coffee, and they give you the sort of status, and that's how they get you. Yeah, it's only 1.25%. That's nothing. That's what they've got you thinking. It's like a tip. After 30 years, on year 30, 632,471. So they have extracted millions from you. It gets worse. It gets a lot worse. Let's say they upsell you and they say, okay, what we can do is we can actually get you set up with a trust. We can be your trustee. We can set up your asset protection. Yeah, because this is what people think. Family offices and getting you the asset protection, they'll set you up. So it gets worse. What happens is it costs more money. So instead of the 1.25% AUM fee, they add on a 0.5 trustee fee, they add a 0.5 fund expense, so you're now getting drained at 2.25%. Now your net return is 4.75. So as you can see here, by year 30, they're taking nearly $1 million of the balance sheet. Keep in mind, that is whether your portfolio is up or down. It does not matter. They don't care. They get paid either way. That's why the wealth management industry is probably one of the most profitable industries, because they don't care if your portfolio crashes 20%. They still take a cut. So they're slowly liquidating you, and your free lunches and free coffee and things that they were giving you at the start doesn't really feel free when you start looking at these numbers. Even by year 4, they're taking $250,000 from you. And you might say, well, who cares? You know, who cares? I've got a private bank. You know, I feel like I've got that status. They're taking full advantage. That's the point. It's the principle of it, if not even the financial of it. But what we need to look at is this net return, 4.75%, because it's going to get a lot worse. I know I said it's going to get worse, now it's going to get a lot worse. In 1959, in the US, there was $286 billion. That was all the dollars on the planet. Today, there's over 22 trillion. The more dollars that are in existence, that's your share of the earth being reduced. You're being diluted. You're being diluted by 6.74%, to be exact, a year. Let's look straight from the Federal Reserve's website. As we can see, there's the numbers right there, 286 billion in 1959. And it's now 22 trillion. The more this number goes up, that your purchasing power is being eradicated. But it's so slow that people don't really notice it. They don't notice it until they say, things just feel more expensive. See, we don't on this channel, we do not track the consumer price index. That's the cost of milk, bread, eggs, and iPads. That's the cost of survival. That's not the cost of assets. Assets track money supply. So as this goes up, the S&P 500 goes up, stocks go up, assets go up. So we must be outperforming this. So technically, the portfolio here is actually losing money every single year because it's only getting a 4.75. It's less than the money supply is increasing. Now, the money supply needs to keep increasing because the US, there's a sovereign debt spiral. As you know, look at the debt. And the news for this is it's only going to get worse. The debt is going to get bigger and bigger every single year. And more dollars will be getting printed and get pushed into circulation. And your share of the earth goes down. Now, if you understand this is your enemy, you then understand how to defeat it. Now you know the sovereign debt crisis is the problem, and the money supply M2 is your enemy. You then know how to defeat it. So we must have assets that outperform it. And ironically, the more the money gets created, the more our assets will go up anyway. And if the assets are already outperforming it, we're always ahead of it. No matter how big the debt gets, no matter how big the debt goes or it hyperinflates, the asset holders always win. Look at the man from Germany, Hugo Stinnes. This is who we learn from. We learn from Hugo Stinnes. This man here, right? Before Germany hyperinflated, he used the cheap debt to buy assets. And even if the currency hyperinflated away, he still had the factories and the assets left behind. So that it's history, like during Germany's hyperinflation period, he borrowed vast sums of paper marks to buy tangible assets, factories, mines. He repaid the loans with nearly worthless devalued currency. He effectively acquired vast industries for a fraction of their value. So he realised that, this money is just paper money. It's printed and it doesn't really mean anything, but the actual assets do. So that's why we invest in our stocks, because we have shares of real companies that are productive, that are actually pushing civilization forward. So we learn from Hugo and we outperform the money supply. Anyway, back to the private banking section. So we've established here that the portfolio is getting dragged terribly. Look at the chart. Yeah, look at this. This is over 30 years, the difference between someone who did not pay a fee versus someone who did pay a fee. The difference is nearly $20 million. Yeah, look. So the guy, the investor that went with the legacy bank finished in 30 years with $53 million, and the person who did not pay the fees, $76 million. So what the private bank did was they extracted over $20 million from your children's inheritance. They took that money straight from your bloodline. But hey, look, they paid for gave you a nice coffee, and they had a nice smile, and they look friendly, and they paid for your lunch. You start to see the truth. This is the truth. Look at we act as an investment advisor, as a broker, depending on our relationship with you. Our roles and obligations vary. What the professionals do is just use them as a brokerage. because it does get even worse. It gets even worse. Because what they'll say to the client, this client here, let's imagine, what they say to them is they go, there's actually a secret thing that the wealthy do called buy, borrow, die. Instead of selling your assets, take a loan against it. This is what Jeff Bezos does. So because Jeff Bezos does it, you should do it too. And the client feels exclusive. The client feels like an insider. They're copying the strategies of the ultra wealthy. And then they get a Lombard loan. A Lombard loan is a fancy name for a margin loan. And the loan probably is like 5%, 6%. So not only is their net return 4.75, their assets are not even outperforming inflation. Then they're taking a loan. So it's creating a death spiral for the portfolio. Their wealth is just going into a complete spiral because they think they're copying the strategies of the billionaires, which is a legitimate strategy that I teach on this channel. Because there's only certain ways the strategy can work. The asset must outperform the money supply to begin with, and it must outperform whatever the interest rate is on the loan. Now, I can't tell anyone, what broker to use. That's not allowed. You can't do that. But let's just take a look here. Look at this rate here. 5.14% under 100k borrowing. Above 100k, 4.64. Benchmark plus 1%. So this broker, this institutional broker, you're effectively borrowing not far off what the actual US government pays to borrow. So if we have that as the cost of the loan, and our hurdle rate is 7%, if our asset is generating a return of like 15% to 20%, you can do the buy, borrow, die strategy with the correct assets. You can't just borrow against a completely passive portfolio. The strategy just doesn't work. I see people online, I've seen people borrowing against the S&P 500, and it's just, they're liquidating themselves slowly. They don't understand the only way to do it is with assets that are massively outperforming. That's why the billionaires can do it, Jeff Bezos can do it, because obviously his asset was vastly outperforming. He owned Amazon, so the shares were going up so much faster than inflation. So what do you actually need to do the strategy without paying a fee? You just need your own brokerage, your own digital family office. That is what I teach on the channel. Okay, so we don't need a bank. Technically, a brokerage is more secure than a bank just because of the structure. You see, a broker, the assets are all segregated. If you own stocks, it's a segregated security. If you have cash, it's only covered up to the deposit insurance limit, which in America I believe is about 250k from memory. Let's check. Let's see. I think it's 250k. Yes, it is. There you go. 250k, joint account is 500k. So if you have $1 million in a bank and the bank goes bust, wave goodbye to your cash. But if you have $1 million in stock in a broker account, as long as the broker has a healthy balance sheet and they've actually assigned your stocks on the register or the ledger, your stocks are protected. So there you go, there's the math behind private banking. I hope you enjoyed the video. More on the channel coming soon.